As we mentioned before, Axel, Merk's hard currency fund is beating out 95% of its peers over the last year, in part because of plays on emerging markets and Asian currencies. For more on the currency markets and where else he's investing, Axel joins us live from Mountain View, California. And I really want to start with a focus on the economy, Axel, considering the fact that we just finished this G20 meeting and there were so many interesting things that came out of it. But you and I were talking on the phone earlier today. The U.S. wants to reduce dependence on overseas capital to finance consumption while cutting the reliance of China and other creditor nations on American consumers to buy their goods. This all sounds like a great plan, but how on earth could we actually do that?
Well, not on this planet, anyway. We'd like to depend less on foreign creditors, and the most reasonable way to do that is to issue less debt. Unfortunately, that is not in the cards right now. And so what the U.S. wants to do, they want Chinese people to all have credit cards, and the Chinese say, no, we don't want to give everybody a credit card to spend. We want them to increase their purchasing power, and that's going to take a while. So there's a lot of talk at the G20. There was a lot of talk, but there is very little action to actually follow through.
How would you were saying you'd like to see market forces, or we're going to see market forces shape this, regardless of what the altruistic policies coming out of Washington and Beijing are. How do you expect that to happen?
Well, ultimately, what's going to get the Chinese to move is, in my view, not some good-hearted thinking that they'd like to rebalance the world, but they're going to do it based on forces. And the force we see is inflation. In China, in particular, money supply has been going through the roof as they have been trying to reflate their economy, and that's going to cause an inflationary problem. The best and most effective way to fight that is with a stronger yuan, with a stronger Chinese currency. And ultimately, they move in that direction. They're putting everything into place. Now, it's not going to work the way that the Japanese are doing it. They have a new government, and they don't seem to know what they want to do. And in the meantime, in the short term, the currency is appreciating. They think it's great news for them. Let's wait and see how the Japanese are going to react. The trouble in Asia is that policymakers, with the exception of China, don't have a steady hand, and they may change directions on short notice.
Hey, you bring it up. I mean, the Japanese first said they don't mind if the yen appreciates. Then they kind of backtracked a little bit. It's a brand new government. Obviously, the first time we've seen a new government there in decades. As someone who owns the yen, who's made a lot of money on the yen here, how do you feel about this? Does it make you nervous?
We only started buying the yen about a year ago, and then even more so towards last October, when the Japanese banking system, sadly, was the strongest one in the world. The reason we started buying the yen last year was because of the lack of intervention. The Bank of Japan was in utter disarray, same with the government. And now, if they continue to have a hands-off policy, then the yen can appreciate substantially so. The question really is, will the government keep a steady hand? Will they stay aside and allow market forces to play out? Remember, the Japanese example shows you do not need to have growth to have a strong currency. In fact, the U.S. is trying to get out of this mess, out of this depression or recession scenario by devaluing its currency. So if you don't do that, you might end up with a strong currency. You only need to have growth when you have a strong current account deficit, which the Japanese don't have. So they don't need to have growth to have a strong currency.
You know, a lot of people here in the U.S. have said, okay, this problem is simple to deal with. We devalue the currency and make our debts easier to pay off. Is that a dangerous road to follow?
Well, if you think that we'll export sneakers to Vietnam, by all means, try and go for it. But other than that, I think the Europeans, they've gotten it right over the years that you need to focus on value-added products if you want to live in an advanced economy and have and be able to compete. You cannot compete on price, no matter what you do. A weaker currency is going to help you for a quarter or two. But the U.S. is too highly dependent on the fact that it's in nobody's interest to have a weak dollar. But that is not a policy going forward. You need to have policies that support that, and printing money at this scale that the U.S. has been doing it is just not sustainable. On top of that, in our view, the Federal Reserve wants to have a weaker dollar because they want the price level to rise. They want to bail out the ones with debt. They want home prices to go higher, and they're doing it in full force, amongst others, by buying government bonds, mortgage-backed securities, so that rational buyers stay away from the dollar and look for returns elsewhere.
All right, Axel, we're going to take a quick break. When we come back, I want to talk about the difference between what you think the U.S. should be doing and what you think they're going to do. Stay with us here on Bloomberg Television. All right, we are back now with Axel Merk of Merk Mutual Funds. And Axel, you were saying before you think Ben Bernanke wants a weaker dollar here. If Japan is happy to have its currency appreciate, and you've got other currencies that continue to rise because people are betting they'll raise interest rates first, like Sweden, like Norway, like New Zealand. How much further do you see the greenback falling?
Well, quite substantially over the years. One of the things in the context of Japan is that because the new Japanese government may be unpredictable and because of how the interest rate differentials work, the US dollar has become the funding currency for the carry trade. Carry trade, obviously, where you borrow money, you sell a currency in a currency where you pay very little interest to buy a riskier asset. Traditionally, that's been the yen. That's now the US dollar. That's a shift, in my view, that's going to take years to take place. And the US dollar on top of that works extremely hard, the policymakers behind it, to get it weaker. I mentioned Bernanke is trying to weaken the currency. It's, by the way, something he has explicitly stated when talking about how the U.S. got out of the Great Depression to go off the gold standard. I have no doubt Bernanke is going to try to do anything in his power to do this, and in my view, he might get more than he's bargaining for.
You know, a lot of people have been complaining about this. David Malpass, one that we've had on the show a lot, and today Steve Forbes on a Bloomberg program said that because of this, the economy may face another fall off after an initial rebound resembling that of the 1930s and 1970s. Do you also share the view that we could see a double-dip recession here and that it could be very bad?
Well, we will, in my view. And the key problem we have is that we haven't allowed the consumer to deleverage. We need to give heavy subsidies for consumers to buy a home. You still can't afford a home with a reasonable income, with a two-income family. And what that means, basically, is that if at some point inflation breaks out to the open, there is no way on earth, in my view, that the Federal Reserve is able to mop up the liquidity, to raise rates. You can't have a Volcker-style policy of the early 80s, raising interest rates substantially, and all the other methods that have been discussed, reverse repos and the like. They've never been tested on a trillion-dollar scale. It's just impossible to implement. So both structurally it's going to be very difficult, but just as far as the impact on the economy is concerned, in my view, it's going to be almost impossible to mop up this liquidity. And so we will either see very serious inflation or fall into a recession, depression type of scenario. And because the latter is not what central bankers want, I believe that we'll fully count on the inflationary path after a lot of volatility to play out.
What do you think about tips as far as a protection against that kind of scenario?
Well, if I thought they were to protect me, I would buy them, but the spread is way too low. The government has said that inflation outlook should be a little bit higher. They have a target rate of about 2%. The spread is a little bit under 2%. So obviously, if you think that, then tips may be the preferred choice, but I think even tips, the way they measure inflation is not going to protect you as far as purchasing power is concerned in the medium term.
And hard commodities, you think, though, will? I wonder your thoughts on gold, for example.
Well, they might, but of course volatility is high in those. We do like gold. We have a gold component in our hard currency fund. The volatility in commodity spaces traditionally holds. So what we do is we buy basket of currencies. The challenge is really there is no such thing as anymore as a safe asset. And we've said you have to take a diversified approach to something as mundane as cash. But the commodity space is something that is benefiting from a world where we're printing all this money, but it's applied extremely inefficiently. So we see the monetary impact first in the weaker dollar and in the commodity prices going higher.
All right, Axel, thanks so much for spending some time with us today. Appreciate it. Axel Merk there of Merk Mutual Fund.